we're going to talk about some additional components that you might have with some of your lease agreements, and to determine whether or not they are considered as part of the present value calculation that you would make for the lease liability as the lessee, or the lease receivable for the lessor, or if not part of that calculation, if it would be a component calculated as part of the deferred inflow of resources, again, as the lessor, or the asset by the lessee. So let's just jump right in here and talk about some components. So we're going to make an assumption here that the lessee, in our example, of course, the lessee is the school district. We're going to make an assumption that the lessee is going to be making a payment of $6,400 on the execution date. And if you remember, Amanda went through this a little bit earlier, the lease execution date or the signing date was February 18th of 2020. So when they make this payment, it's stipulated that this initial payment is going to be covering the first 2 months of rent that are due under the actual lease term. So let's decide whether or not this is a component or not. Well, the $6,400 is prepaid rent. And so generally prepaid rent is going to be a component. It's actually going to be included here in our calculation. But when the payment is made in February, worth noting that the lessee is going to have to make an entry, and they're going to debit a prepaid for those 2 months, and of course credit the cash because they're making the payment. On the opposite end here, the lessor is going to be recording a debit to their cash for receiving that payment in advance, and they're going to credit a deferred rent or deferred rental income, and it's just basically going to sit there in that deferred account until the actual lease term commences, because then the lessor can begin recognizing income on the lease. All right. Next, we're going to think about an additional component here. The additional component is going to be the actual payments. So every single month after commencement, the lessee, again, the school district, is going to be making payments of $3,200. Those are going to be made monthly. And it's going to start 2 months after the contractual lease commencement date, which in this example would mean it would start on October 1st. The reason for that is because they already prepaid those first 2 months. So they're going to start making payments as of October 1st, 2021. And the rent for each month is going to be due in advance. So they're going to be making the payment on the first of every single month. So is this going to be a lease component? Yes, hopefully this one was easy because this would be considered the lease payments, and that's going to be included in our present value calculation. Again, the 2-month prepayment is going to be applied to the months of August and September. And then this component here is going to be the first part of our calculation that we are going to go ahead and do after this section. All right, next. You might have some of these as well in your leases, but the landlord, again, the city, is providing as part of the lease agreement here a $5,000 tenant improvement allowance. And this is to pay for improvements that the landlord, again, the city, is still going to ultimately end up owning. Now, this incentive is $5,000 directly paid to the lessee in its entirety on the date of early access. So if you recall, that was July 1st of 2021, which is before when the lease was supposed to start, but they got early access to the building. So is this a lease component? Well, yes. This is what we call a lease incentive. It's an inducement offered by the lessor to encourage or try to get the lessee to get into the lease agreement. If you want more information about incentives, they are discussed in paragraphs 61 and 62 of GASB 87, and they're defined as payments made to or on behalf of the lessee, for which the lessee has a right of offset with its obligation to the lessor. An important distinction here for incentives is the timing of the incentives. So the timing of the actual payment of the incentive is going to dictate how it's accounted for. Now, since we noted here in this example that this incentive is to be received at commencement of the lease term or at our early access date, it's going to be included as a reduction in the initial measurement of the lease asset for the lessee. Conversely, it's going to be a reduction of the initial measurement of the deferred inflow of resources for the lessor. If, in fact, the incentive were to be received after the lease commenced, So if it was receivable at commencement, it would be treated instead as a reduction of the lease payments for both the lessee and the lessor. And so it would actually impact the liability measurement and the receivable. We'll talk about that when we go through how to actually account for this. All right, lastly here, our fourth and final component. On the lease execution date, again, February 18th, 2020, in addition to that prepayment we talked about, the school district is actually making a payment of $5,000 directly to the city, the landlord, and this is going to serve as a security deposit. It's also noted that the city is going to return the security deposit in full to the tenant upon lease termination. So is this a component? Well, generally, no. When you have security deposits, they're actually separate assets from the lease. They're not going to be included in the liability or the receivable calculations. But rather, the lessee is actually record an asset or a receivable, and that's just going to be sitting there until the end of the lease because it's refundable. They're going to get it back. The lessor, on the other hand, is going to record a liability because they're just holding on to this cash. They're holding on to this until the end of the lease term. So generally speaking, no, security deposits, especially those that are refundable, are not going to be included as a lease component, but rather just separately.
Now, in my opinion here, when we start talking about determining the appropriate rate, this can really be one of the hardest parts of the new standard next to collecting an inventory of your leases. So we're going to break that down for you. Now, first, we're going to start with the lessee. So we're going to understand it according to each user's or each particular lessee or lessor's role in the actual lease. So we're starting with the school first. After you've determined your role, you should think about whether you have enough information to determine the implicit rate in the lease. Now, the implicit rate is actually defined as the internal rate of return on all the payments or receipts related to the lease. While this is going to be the starting place for the determination, of the rate, it can really be difficult, especially for the lessee, as the lessees aren't typically privy to the types of inputs, and the lessor is probably unlikely to provide the internal metrics that's going to provide them with that rate of return or the profit. So instead, if you can't determine what this rate will be, you can apply the incremental borrowing rate. This is the rate that will be charged for the borrowing of the same amount over the lease term. So as we take a look at this graphic here, we have two rows, both for establishing the rates. But now we have to consider the classification of the lease and the start date of the lease. GASB 62, which is under the legacy standards, it actually mentions that the capital lease determines the rate at the inception date, which is the date that the lease is going to be signed. However, under GASB 87, which is the new guidance, the rate is established as of the commencement date. So this is going to be the date in which the ownership is being transferred. So really big difference here in the timing or the start time period of assessing the rates. Now, in our example, you may recall that the lease was signed in February of 2020 and is going to commence as of August 1st. That's actually going to be the actual date. Now, the July time period is the early access there. So that's when it's actually going to begin. So for the Eastern School District, they're unaware of what the implicit rate will be. So you'll see there with the graphic there. So we're going to be applying the incremental borrowing rate. As of when? We need to determine this. Is it the actual the commencement date, as you'll notice here, or is this actually going to be the inception date? So based off of what we've learned, this is actually going to be the commencement date. So the school will have a 7.2 borrowing rate to establish the lease liability. Now let's take a look at the lessor. So this is the city. We've learned that the city of Springfield, they should be aware of the implicit rate, But the implicit rate, it equally balances the lease payments and the fair value, and we really haven't touched on that and what all goes into factoring that in. So I want to walk through that at a high level as we understand more about those inputs. So the lease payments and the residual value of the underlying asset. The residual value is actually the amount that the lessor expects the asset to be at the end of the term. So remember, as a lessor, you're providing the lessee with the right to use the asset for a period of time, but you still own the asset. And in our example, the city is still owning the building as well as that parcel of land. So we're evaluating, or the city will evaluate how much this will be worth once it's returned. So that will be important. Additionally, with evaluating the implicit rate, the lessor has to consider the market value of the asset, which may be different than the market value of the right to use the asset. So both of those can be different, the actual value of the asset and the right to use that asset. If these values are different, then you should use professional judgment to estimate the value. Now, in assessing the rate, the market value, the lessor is also going to be required to understand any retained or expected investment tax credits. And this is going to be subtracted from that market value. So it's important to factor that into the assessment of the market value of the asset. And then finally, the lessor is going to need to consider any initial direct costs. So with all that we've covered so far with the inputs, you can understand that this is quite a bit of information. And again, while the lessee may not be aware of this information, it may also be a little challenging for a lessor as well. And so with that being said, I want to talk about the implementation guide number 2020-1. Question 4.15 actually provides interpretation that allows lessors to also use the incremental borrowing rate. And that's only if there isn't a stated rate or an implicit rate that can't be determined. So of course, we always want to start with the implicit rate, but if it isn't, you aren't able to determine that, you can apply the incremental borrowing rate. However, in our example today, we are aware of the implicit rate. So the city is going to apply a rate as of the commencement date. So that's going to be 6.5%. As a recap, the school district has a rate of 7.2% and the city has a rate of 6.5%.
And then I know another question I've seen here is for the interest rates. Folks wanted to know, based on them being a governmental entity and not borrowing funds in the past, they don't necessarily have a set incremental borrowing rate. So what would they do in that situation?
Of course, as I mentioned, starting with the implicit rate is typically where you want to start. But the next best thing is the incremental borrowing rate. So this is essentially taking a look at the details of your lease agreement. So evaluating the lease term, evaluating the lease payments, and then considering that the terms of your lease in a loan that would apply the same details and what you borrow with those metrics.